Welcome back. The Reserve Bank of India has tightened the rules for NBFC's bad loan norms have now brought in par with banks. Ramesh Iyer, the MD of M&M Financial Services, now joins us on the phone line to detail the impact. Afternoon, Mr. Iyer. Thanks so much for joining in. Can you walk us through what the impact will be on your company on the back of these guidelines?
No, one is, this new guidelines which have come about, which talks of 2016 going up to 150 days in terms of provision, then goes to 120 and then finally goes to 90. So the current balance sheet will run off by that period of time, not much will be left in this balance sheet. So one has to only look at any new business that we'll start doing from this stage. How do we start bringing in this new regulation into place and start preparing ourselves? So in our case particularly, we already have a 150-day norm for our book. So definitely for next 1 year, we don't see any much impact. But clearly, yes, what it makes it happen is you make a little more aggressive provision going forward in all the new portfolio that you will inherit, and to be in line with what RBI is talking of 90 days by 2018.
So in that case, sir, when the bad loan limit is brought down to say 5 months next year and 4 months thereafter, what will be the likely impact on your NPLs, the incremental impact over there?
No, which is what I'm saying. From the current book point of view, we will have no impact because we are already on 150 days. We have prepared ourselves for it already. Right. So therefore, any new loan that we will take in, if we start preparing ourselves to say we start making a provision of 120 days instead of waiting for 150 days, then you can ready yourself from a new book perspective. So the good news is that there is a phased out time that's given. So it doesn't have an impact on your current book immediately. But clearly, what one should also realize is that this kind of assets do go through cyclic impact, and customers do need that kind of an extra time sometimes, like for example, a tractor loan, right? We would have preferred that a product like tractor, etc., also are treated like the way banks get benefit on, these kind of seasonal impacts and things like that, and not treat them like any normal asset. So if one bad season, there's going to be a non-payment. But since you have to treat it like any other asset, we will need to make a provision, which is what we are doing today, of course. But on a 150, 180 days is different from a 90 day because, one cycle would mean 1 quarter or 2 quarters.
Okay. So, on the now that the arbitrage between NBFCs as well as banks has been effectively closed out, do you expect increased competition, in this particular segment that you're catered to? Will your market share come down for NBFCs in general?
No, but if you kind of look at it, the arbitrage is closed down on the provision side, right? And therefore, why should the market share be impacted? In fact, we would all become more careful in our lending in terms of our ability to recover will be enhanced. Maybe all of us will open more branches, be more close to customer, right? So I think quality of asset in the book over a period of time will for sure go up. But we would have clearly preferred that when the arbitrage is being shrunk by this method, also the risk weightage benefit should have been given to NBFC. Today, the NBFC assets are 100% risk weightage product. Whereas there is an underlying collateral as an asset which has a resale price. And therefore, clearly there should have been a risk weightage considered. That's one. Two is, the provisions don't qualify for tax payment for NBFC is concerned. We have to pay tax even on the provided amount and the income reversed. And one would have preferred that even that should be taken up. And that was there in the draft guidelines. That the tax benefit should be given to NBFC like given to the banks. And third is the SARFAESI benefit. So we would expect that by the time this regulation comes into its place in 1 year from now and 3 years, by the time it reaches the 90-day norm, there would be enough dialogue that would take place with the regulator, and I'm reasonably sure that they will have clear open mind to listen to also our point of view on these guidelines and its impact. And some suitable actions would be initiated even in that front.
So, earlier this morning we were speaking to the management of Shriram Capital, who actually, from the customer point of view, said that, the customers at the lowest rung of the pyramid would perhaps be left out, given the irregular cash flows, etc. And, it wouldn't be worth even an NBFC's while to perhaps service their loans. Do you see that a situation could be as dire as that? And do you think that this whole financial inclusion plan, therefore, there's a risk that it could go off track?
My personal opinion, though, is that NPA provision is more a precautionary provision. The real concern should be on the credit loss that will bring in, right? Because ultimately, you may make a provision for a customer, but once he is able to come out of the difficult time, he pays off, and you don't really incur a final loss on those transactions. So if this provisioning norm should not dilute in any form or tighten in any form your credit lending norms. So you may run a little higher NPA in the book, and if you are communicative about it to the rating agency, the regulator, the investing community, and everyone else, I'm sure everyone will understand that this is the business model in which you undertake a risk on this kind of customer, and they will run through these difficult times, and you make provision. But over a period of time, they do pay it off, and then you may not necessarily increase your credit losses. So I don't see a loss of business or a group of customer being left out because of this. But one needs to realign your internal processes, your own review mechanism, your point of action may become a little more faster than before. So all that will happen, but I'm not able to see that too many customers will be left out because of this if you recognize the risk well upfront.
Okay. Sir, some numbers from you. Could you tell us currently what the Tier 1 capital is for, MMFSL, and will you require to raise any capital to increase it to the eventual 10% target?
No. I think we are pretty comfortable. We are, in terms of Tier 1 itself, we are close to, I think, 14-15%.
Okay.
And our total is about 18-odd%. So from a capital point of view, we are absolutely okay. In terms of NPA provision also, we are already on 150 days, so we are 1 year ahead of the requirement.
Okay. And what about standard asset provisioning? Where does it currently stand at?
We are already at 40 basis points, so we are already in preparation for what was likely to happen.
Okay, and eventually in year 2, when you have to bring down your current NPA recognition from 150 to 120 days, at that time, what will be the impact on the book, on the NPLs, as well as, the provisions? I understand in year 1 there'll be no impact, but what about year 2?
No, that's what I'm saying. See, if today you're already on 150, by your process you will bring down the customer account to a 120-day level. So I'm not able to see 150, 120 will have any major impact. And even if you assume that quality continues absolutely the same way and it comes down from 150 to 120, maybe there could be a marginal growth of NPL. But one should also not forget that we are all going through difficult times where the numbers look different, and market conditions improving, many of this will correct itself also.
All right, Mr. Iyer, I appreciate your time and your thoughts on this subject. Thanks very much for speaking with us. And that's the management of MMFSL saying that perhaps that they do not expect much impact now. And Rima, as the saying goes, that sometimes you have to put your foot down to get a leg up. So that's at least the word that's coming in from all the managements we've spoken to on this subject so far.